So, hi, this is David Skarica, and this is actually a really special edition of the Contrarian Corner. And actually, I've usually done this in a kind of, a PowerPoint format, but this is really the plan for the show, like, ultimately, is that this is the corner, it's the corner of my deck at my house in Eleuthera, Bahamas, and I'll tell you the concept in a second behind this whole show. But this is the corner right here, and I like to interview guests and talk about markets, and ultimately it's going to become more almost of like a TV kind of show rather than just, say, PowerPoints and information on the markets. We'll keep that aspect of it, but really I want to do more in-depth type interviews. And, because you watch CNBC or you watch Bloomberg or whatever, they will have a guest on, and most of the interviews will be 10, 20 minutes in length, and always cutting to commercial and telling you what the market's doing every 10 minutes. And I want to do something a little more in-depth in Contrarian. So the first Contrarian aspect about this is where we are. Now, one reason it's difficult for me to get guests all the time is that I don't exactly live in New York. I live, they say the island of Manhattan. This is the island of Eleuthera. And there's only about 12,000 people who live here. It's kind of on the cusp of civilization. Like, when you look over to the east there, the next piece of land is Africa, right? This is further out and east into the Atlantic that you're going to get in the Caribbean. So, that's the one aspect that makes it a little difficult to, get guests and that sort of thing. And the second thing, and being contrarian, is, again, that's where we are. Right? We're not in New York, we're not in this, we're in this kind of place way out there talking markets and philosophies and that sort of thing. And, the corner comes from the idea that this is actually the corner of the deck of my house. So Mike Swanson's probably my best friend in the markets. He's someone I've known in the markets for almost 13 years now. We met in, I think, about 2002, early 2002. And we've been through a couple bull markets, a couple bear markets, a couple gold booms and busts. And so, Mike, I think what we want to do to start, before we get into our feelings, our macro feelings on the market currently, maybe get into how you got started, because you don't really have a financial background. You were a history major, so just talk about how you ended up trading, how you got started in the markets, and then we'll go from there.
Well, to make a long story short, I was a graduate student at University of Virginia. I had gotten a master's degree in history, and I was on track to, I guess, become a history professor, and I still like history, write history books, in fact. But I didn't really want to do that as a career. I kind of got soured on the notion of doing that for all kinds of reasons. But at the same time, I started getting interested in the financial markets, and this was in the mid-'90s, and the 1987 Asian crisis was going on, and you would see on the news all the people talking about it, and markets swinging up and down, and volatility. And I'd always been interested in financial history, because I think economics actually is, or I used to really think that economics drives history, but it still does in many ways. But so it was a topic I was interested in. I was like, well, maybe I can try to make money at it too. And so I got into trading while I was still a student in college. And then I dropped out and wasn't sure what I wanted to do with my life, and moved back home. I said, well, I'll move back home for a year, try to figure that out. But I still traded, and then I decided, well, I'll just keep trading. And then I set up my website, subscription service, and so forth around the year 2000, and made money in that bear market by shorting stocks. So I was someone who got in during the bubble of the 1990s, and I at first was trading tech stocks, but I knew they were bogus and it was just a bunch of hype. But that's what was going up. You
knew the bubble was going to blow. Because, by the way, I started a little earlier than you. I started in about 90, very young, 95, 96, when I was about 18, 19 years old.
Right.
And I first was trading gold juniors, because being from Canada, that's a big sector there. I was a bit of a gold bug from day one. And then I started trading some tech stocks too in the late 90s. But I had the same mentality. My first book, Stock Market Panic.
Yeah, you laid it all out.
Yeah, it was 98. I said this is a bubble, right? So, but I was also still trading some in small amounts because, you could make some money doing it. And at the time, too, I was also a big fan of Jim Dines. And Dines was he called himself the original internet bug, and he was really into a lot of these companies. But anyhow, just to get back, it's like, yeah, so the difference I think between us and others then was that we didn't own CMGI or JDS Uniphase or Nortel or something.
No, not as investments.
Not investments. We just were trading in and out. And basically what I did is, and we'll get back into how we met here, is I really always had this core of gold stocks then. And then, really in 2000, when I felt the market had now blown off and the bubble was bursting, I was almost all in precious metals. 'Cause I didn't really know about shorting then. I didn't really done it. I played a little bit of options here and there, right? But I really was interested in the shorting aspect. In the gold aspect and the precious metals aspect, and this being the bottom of the precious metals cycle back in 2000, 2001. So, and that's kind of how segue to how we met.
Well, one thing about that bubble is I was living in Charlottesville, and when I was in college, and there is a company called Value America, which was an internet website. I don't really remember exactly what they're doing, selling consumer goods, but they did an IPO, and the stock opened up at $50 a share. And the company's worth hundreds of millions of dollars, or maybe even $1 billion. And it was one of these hot IPOs, and the company had a headquarters in a residential neighborhood, just a house. And I drove by it, and I was like, "That's Value America." And I was talking to someone.
Sounds like Boiler Room.
Yeah. And I was talking to someone I knew in college that said, "Oh, I know Value America because I go to church, and one of the board of directors goes to my church too, and he tells me that their company might go bankrupt, and he's trying to change things." This is freaking. I mean, it's just an example of the silliness of the boom. But when I moved back home, we had a eToys distribution center in the town I live in, and people were buying that stock and lost money. But the thing is, I think back to those times, and then people that were buying like the eToys or these Value Americas or whatever, they understood that they were speculating and trying to make a killing, and it was kind of crazy and so forth. So it's a little bit different than the attitude of people today. But anyway, kind of getting off on a tangent here. So the bear market happened in 2000, and in 2002, in February, I got sick for like 2 weeks. I was just laying in bed, and somebody called me on my Andy Emerson called me on my phone, and I wasn't answering the phone because I was just ill and laying around. But I finally picked up the phone, and he said, "You've got to look at gold in mining stocks because they're coming out of a stage 1 base while the rest of the market was falling at the time." So I got really excited about gold stocks, and I didn't really know anything about them, and I never even really thought anything about them up until that moment. And that's really how I got in contact with you. I met you somewhere on my track on a message board chat room.
Remember, this is
we were
before
talking about gold stocks.
This is before Facebook, even before Skype.
Yeah.
So people were.
And of course, you wrote your book.
I wrote my book,
right?
and people were talking on message boards at the time because stock message. And I think my track still has that message board, if I'm correct, right? So people were talking more on chat boards, and I used to just go on there while I was trading, right? And actually, half the time, because one of the guys, I also became friends with, his dad was a very famous football coach for the Denver Broncos, and actually, I'm a Raiders fan. Used to coach for the Raiders for a while. And anyhow, so I actually was talking more about football with these guys than I would be stock investing, and then that's how I got you. And you were just telling me. I remember you wrote me, "Oh, the gold stocks are just starting to break out." And I was just like, yeah, I've been in them for a while, and they look, I think that we're gonna.
And gold was like $270 an ounce or something.
Yeah, it was late 2001.
Yeah, so in 300, it was really interesting because one of the things about this is gold, the $300 level for gold had been resistance for several years, and you can just see on the chart if we break this level, we're starting this giant new bull market, and today probably 1,300 or 1,350 is the equivalent price level of what 300 was back then. But the thing is, there are all this talk at the time that there's Elliott Wave people that were saying gold has to fall to 190 or whatever some magic level, and of course it never did that. And then other people were saying it's manipulated and it can't go up, and if it does go through 300, it's going to bankrupt everybody. And it is just kind of interesting how
it played out.
Yeah, how people were talking about it at the time, and of course it did break 300. And my experience was that I don't remember the amounts of money it was, but I bought a big position in February, March, and Andy did also at the same time, and it went up tremendously into July, and I took a trip, and gold made a temporary peak, and I sold out a few days after the peak, and I had been up like 100%, but I sold for like a 10% gain, and he held an extra day and just broke even, and he had like a huge profit he lost on paper, and it was just a day's difference between me making a little bit and having made nothing, and I still didn't make, what I would on that short-term trade. But that just showed me how volatile gold is. And then after that, I got back in at some point over the next couple months or something, and then the year after that, it did very well.
Yeah. Well, see, and another point on that, you're talking about how we thought at the time. I remember there's another friend I met at the time, and we were debating. This is really funny in retrospect. If El Dorado was a good buy when it was like 30 cents. Because they had like a lot of companies back then, a lot of these companies were hedging to stay alive back then.
Right.
But of course you can just buy out the hedges, just like oil companies can buy out their hedges, right? So we were debating, is El Dorado a good buy? Should we be buying this stock? And, they got hedges, they got this, can they survive? And of course it was 30 cents then, which is funny because El Dorado is a $6 stock now. And it was a $20 stock at the height of the market. So it's just funny in retrospect, way you viewed the market. And we're talking about how no one thinks the stock market can go down now in other videos.
Yeah.
And in general.
At the moment, yeah.
And gold was the exact opposite in 2000, 2001. No one thought gold good. I remember people thought that when it went through 500 or 600, that it was like, going to crash again. Because no one really thought that gold could do a long-term bull market again, right?
Well, that's one thing. Like, we're doing this video in March of 2015. What seems to be, a major topping time for the stock market, in which everyone is very bullish. And in my website, I have this stock market course, and the first part of it's about psychology. But it's kind of looking back at that. I made this thing in 2009, and the thing about psychology I created is all about individual psychology, dealing with your own emotions and how that impacts your trading. But actually, what I don't really talk about in that course, more like write about, I guess, all the time, is probably more important in a certain sense, is the mass psychology, which is, like you talk about quite a bit. And what happens is at these turning points, everyone seems to be all bearish or all bullish, but what happens to the person is it's so easy to get caught up in that crowd psychology.
Yeah.
And that's not really, that's really hard for people to get out of. It's really key turning points.
Well, what's funny about that again at that time was that I don't even think they exist anymore, but there was something at the time called the SIE group. And they tracked newsletter performance, and you would also give free samples or a free trial or, a simple, like a $2 a month trial to your newsletter for a month or something. And then you would gain access to those emails and then, could get them to become regular subscribers. And so I used to always get like 5 or 10 subscribers a quarter through this thing. And then one time, boom, I got like 100 subscribers. And I was like, what just happened? And they wrote me and said, like, oh, it's the performance. And I looked at it because every quarter they update the performance. And through this quarter, in like sometime like 2002, because the market had been going down for 2 years, what happened then was all I owned at the time, I had like 80% of my stocks were gold stocks. So I had like everything going up for 2 years, and I think the performance was over a 1 or 2 year span. So I had everything going up, everything went down. So it was funny. It's like there's 1,000 newsletters or whatever. I think it was 300 newsletters this tracked, and I'm second in performance, just because all I did was buy one sector that was cheap at the moment, and I didn't even realize at the time, but I was doing the type of investing that we talk about. I was doing the John Templeton the maximum pessimism investing, because I bought gold stocks when they were dirt cheap and just kind of like rode them higher. And it just shows you also secular bull markets. You know, we like to trade in and out and all this sort of thing, but even with the recent decline in gold stocks, many of these stocks, like I mentioned, Eldorado, are still up 200 or 300% in the last 15 years.
Yeah.
Or just are 2 or 3,000%. And you would take a 20 to 1 gain over 15 years, even if that stock fell half from its high, right? So it's just really, really interesting on how we met. So another question I have for you, because, you know, I wrote my book, and the reason I became a bear, just to get this story quickly, was that I started reading all these books when I was 16, 17, 18 years old. It's really weird things to read for a 17 or 18-year-old, but Doug Casey, and you saw in my house I have a book called Bankruptcy 1995, and actually I have a little book that's still on my bookshelf here called Plague of the Black Debt that James Davidson wrote, and it's about how all these welfare states are going to blow up and go bankrupt from just having too much debt on their books and stuff, right? So I got all interested in this so-called doom and gloom stuff. That's how I got interested in gold, and that's why in the late 90s I thought the market was a bubble, because I thought that the whole system was a bubble. And they've actually made this bubble continue a lot longer than I thought they could. But anyhow, so what made you, that's how I'm saying that I became a bear and more open to being bearish, is that I had this view that not just so much the markets, but the whole economic system is unsustainable. That the welfare state, the U.S. industrial military complex, these things are all predicated on unsustainable government spending. And at some point, we're going to have a big debt crisis. And that's why I've been very, very wary of any long-term bull markets. So how did you become, because you were someone, one of the few people, I know, just in general, who made money in the 07, 08 bear market. So how did you become more open to or like looking up bear markets? I know you're a big fan of Stan Weinstein, which I am as well, but how did you basically kind of look at making money in bear markets and being very wary of when bull markets, rather than just being like the average person being happy or bullish when the stock market goes up?
That's interesting. That's an interesting question, because I didn't read any of those books. You know, I didn't know who these people. I didn't know who Doug Casey and all these people even were. You know, in the late '90s, I didn't know who they were, and I wasn't reading those kind of things. So, and it's an interesting question. I've never really thought of it, but I would guess there's probably two things. One is that I not so much the stock market history, but I'm really interested in history. Read lots of history books, and I did read a lot about the Great Depression, and so the causes of the Great Depression. And there's a big debate over that, you know. But I believe that the Austrian economics argument that the Fed, or part of the reason the Great Depression happened was that they created a bubble in 1929, and the Depression was partly a fallout of that, which some people deny that there was a bubble.
Well, they always think the Keynesian argument is that they didn't loosen quick enough, and didn't do the quantitative easing we're seeing today, and that's why you had when it comes to the actual depression, we're going a little off, but we'll get back in a second. I actually tend to believe, like Milton Friedman always said, because he was a bit of a monetarist, but what he always said is that their mistake, essentially, really quick nutshell, was that they let all the banks fail, right?
Right.
Rather than, if you were the Fed backstopping, giving loans to banks and kept the bank, then when the banks failed, there was a domino effect and then no one wanted to lend to each other. So I think that can definitely be a reason why the Depression got as bad as it did. But the actual bubble bursting and the downturn, to me, I agree with you, is caused by this excessive, loose monetary policy, which led to a stock market bubble. But anyhow, go on. So
But there's all these. It's kind of funny that the topic of the Depression, because the view when Bernanke was the Fed chairman, he wrote about the Depression, and he did this research paper claiming that the cause of the Great Depression was that they didn't lower rates fast enough.
Yeah.
After the stock market topped out, but it's kind of funny because there's this whole literature of debate over the Depression, and for a while it's treated as if he's anyway solved it and he knows the answers. It's just a bunch of bunk, But anyway, so no, it's my interest in history was half of it, and if I can say to myself, well, there was a bubble in 1929, and there's a bubble now in 1999. You can see it. I mean, the value of America is a bubble. It's a scam or whatever it is, and people treat it like it's real. And that's just one example of 1,000 at the time. And that's going to end very badly. Now, I didn't think we were going to go into the Great Depression or something, but I just knew bubbles happen. So that's half of it, and a desire, to profit from that on the way up and the way down. Because, I was reading the Jesse Livermore biography and all these books when I was first starting out, the Stan Weinstein book that you mentioned, and then the Market Wizards books where they interviewed Jim Rogers and a whole bunch of people. So back then, the Weinstein book, the Livermore book, and Livermore's someone who made money by shorting stocks. In the Market Wizards book, where these people are doing this, they're talking about the '87 crash, and Jim Rogers is talking about the '70s. Those works really had a big impact on me when I was first learning out. None of these are permabull, rah-rah books. But the other thing is something that the other half of all this, though, is frankly just growing up. I didn't really quite understand all this a year or two ago, but just being a child and growing up, my father influenced me because he was in the military and he worked in the Pentagon in a fairly high up position, and I had some view into. I'm not saying it was completely correct or anything, but I knew through him in the 1980s. I knew some stuff that was going on that was not in the news or is not reported at the time accurately. So that made me very skeptical of television news and just what we're told, in general by authority figures or whoever it is. So by being skeptical, that makes a skeptical person. That makes me more willing to doubt, a bull market or the crowd position or whatever it is. Well, and that's very important,
What's funny about me with that is I kind of wasn't really like that in terms of the skepticism, but now I've developed that. Like, I might even be more skeptical than you now.
Yeah.
I think that the entire mainstream media, and especially the financial media, it's kind of why I have ideas for shows like this, because I just think that they're basically a joke.
I also feel like I have a much deeper understanding of all that kind of stuff now than I did 5 years ago, or much less when I was a kid. But that's a whole other topic.
Yeah. And so now we get into this. So this is also where I learned a lesson. We're kind of moving along here through the 2000s. So we have the housing bubble, and I was actually the one who told Mike about the housing bubble. Because and again, this is where you learn from your experience. In 1990, Toronto had a gigantic housing bubble. And when that recession happened in the early 90s, that's where I'm from, Toronto, or the Toronto area. And then I remember that, like, Royal LePage, or these real estate companies, they all went down 90% in value. A lot of them went bankrupt. The Toronto real estate actually didn't recover until about the mid-2000s. It took 15 years to recover. So I told you about that, and I was like, but when I looked at it, I was just looking at it as Canadian banks are run a lot better, in my opinion, than American banks, and they don't do, they still leverage and they still do bad loans, but they don't do this thing where, they're packaging stuff in MBS and leveraging it 50-1 or whatever the hell these guys were doing in 2005 and 2006. And I just thought that it was going to be like the Canadian bust, that the home building stocks were going to go down 80-90%. Real estate would go down. Obviously you were going to have some regional banks go under and losses at the big banks. But I guess where I made my mistake is I didn't think, from my experience when it happened in Toronto and Canada, it would take down the entire financial system, right? And what I learned too is I also wasn't as bearish as I should have been in 07, 08, because I looked at the PDE of the S&P because it was all hiked up by the PDEs of these financial companies, and it wasn't that high, even though the S&P was back at 1,500. And I was like, the market's not even that overvalued. But what was happening is, because all the inflated earnings from this financial engineering and mortgage-backed securities and real estate, excuse my language, but for lack of a better term, the E was bullshit, right? It was It was these markups and these values of these stupid securities that were really going to ultimately be worth nothing, right? So that also made me a lot more skeptical. And to bring us today to what's happened today is now I look at the market and people will say, well, the S&P only trades at like 16 or 17 times earnings. Not that bad. You know, it was 30 back in 1999. And I tell people again, the problem is the E is BS. The E is inflated, right? What we're seeing is financial engineering, people buying back stocks, inflating the EPS, able to borrow interest rates at 4 or 5% cheaper than the average, historical average, and that also goes to the bottom line. And then because the economy is not very good, wage pressures have come down, so the EPS is inflated. So what I'm putting together is this is how I've learned. I'm not just looking at the S&P being at 16, 17 times whatever this year, next year's earnings. I'm looking at it as being like, I don't know, probably like 22 times real earnings. Sorry, I got some friends staying here and they have dogs. And by the way, my cat might sneak into the picture once in a while too.
Well, the thing is, like, even as we're doing this video, they've already downgraded the earnings estimates for the S&P 500 from where they were just 3 months ago. So the E is shrinking as we're speaking. But the thing about one of the things about 2008. Whatever it was 2006 or 5 or 7. It was 5 or 6. I can't remember exactly. But you were first telling me about the notion of a real estate bubble in the United States, and you recommended that I read this book. So I got the book and read it, and then I started paying attention to this, and I heard all kinds of crazy stories of evidence of this bubble. As anyone listening to this video can think of things, but. So in 2007, the Bear Stearns thing blew up, and the stock market got in trouble in August and came back. But I read this report by someone on the Federal Reserve saying that they're going to have to lower interest rates to zero because the real estate's going to bust. And I read that, and then I realized, well, that they're really factoring in, a horrible recession or something. So that made me very bearish on the market. But from then on, for that, and then it crashed, of course. But one of the things about this is I didn't even understand until February of 2008 how bad the banks were in trouble. I didn't have any notion of all that. So I didn't even really. And even then, one of the interesting things was last year they released transcripts of the Federal Reserve minutes for up to 2008 and 9, and I was reading these transcripts, and they didn't see it coming, in the first half of 2008. In fact, there's a quote in January. They had an emergency meeting, and one of the Fed people in the transcript is saying that the economy's fine, and his evidence is his computer models are telling him that. And it's just crazy. But one of the interesting things about all this, looking back, and it's not to suggest we know what's happening or trying to predict everything, but nobody really knows what's going on. I mean, the Federal Reserve people had no notion of what was happening. It took me months to figure it out, and even then I didn't think it was going to necessarily do what it did. So really no one can predict what's going to happen down the road. You
keep going. I got to take care of something quick.
Yeah, sure.
Like, this isn't... We're not... Okay, keep going on about that.
Yeah, so, what happens is you hear predictions all the time of this scenario is going to happen to the economy, or this crisis is going to happen, but in the end, nobody can predict these things with such certainty. And what's more important isn't trying to figure all this stuff out in that way, but just to understand what the underlying trend is now, because that has implications of what the next trend is going to be. So as we do this video, it seems as if we're in a topping stage 3 market, which Stan Weinstein calls it, what I put in my book and so forth. And that will lead to a new bear market. Well, that's all you really have to know. You don't need to figure out what will be the cause of the bear market, or what's going to happen in 2 or 3 years, or is it the bonds are going to blow up, or this country going to blow up, or what. It's just you just understand the trend and what the ramifications are, because the next trend in the cycle is going to be this. So you're going to have to adapt when that happens.
I think that's what's really interesting, is that you're talking about those, the way the market tops, is that even with all this money they printed, and let's face it, right now the central banks are just trying to manipulate the stock markets higher. Like, they want, their plan, and I don't think it's much of a plan, is essentially they want to create, or maybe they have already, recreate kind of a wealth effect. And then, then people, if there's some rich guy who's got $10 million of Disney and it goes to $15 million, he takes $1 million out and buys a yacht, or he buys a house, or he buys a Bentley or something. It's just that's what they want. And what's interesting, is even with all that, you're seeing these patterns play out. You're seeing stocks like Microsoft, like Intel, these companies doing the classic phase 3 Weinstein topping formation, where they're kind of starting to top out and then roll over. And Tesla's another one, right? You're seeing this even with all this kind of attempted, I think, a somewhat attempted manipulation of keeping asset prices artificially, inflated.
Well, and there's a reason these stocks are doing this. There's a reason why Bill Gates has liquidated, a huge amount of his Microsoft stock. He knows more about Microsoft than I do.
Like I've been bearish the airlines, and there's one that I don't have a position in now, but I've been in and out on shorts. Alaskan Airlines, and this is what's going on right now. This is and it's funny because people are going to look back at this and just think this is ridiculous in retrospect. Alaskan is buying back stock like crazy. All these airlines are buying back stock because their actually cash positions are pretty good now. But the insiders at these companies are dumping stock like crazy. So it's like they're using money to buy back stock to appease Wall Street, appease activist investors, appease whomever. But then at the same time, the people actually at the companies are dumping stock, right? So, and that's also usually a sign of a top. Now, I think the reason this market's gone so long, because 6 years is very long for a bull market, and 3.5 years without a 10% correction is a very, very long time frame, especially when the market is seeing significant gains. Like I tell Mike, from 1990 to 1997, there was no 10% correction in the market. But from the first 4 years of that, from 90 to 94, the market really almost went nowhere, So that is kind of why you could see that 7-year period at that time, right? But now you've got 6 years of gains where, the market's tripled, and it's doubled just since 2011. So I think that, one reason it's taking long is, because the authorities are basically throwing not billions, but trillions of dollars at this to keep it inflated and keep it going, and force people into risky assets because they just don't want people sitting there owning bonds, not spending, money, or, not making risky investments to try to drive growth or whatever, speculations. So I think that's one reason that it has gone so long. But what I feel is that due to the technical action of the market, this stairway to heaven, this 3-year period where no corrections, and I mentioned in another video, I'll mention here again, that if you go look at in history, 26 to 29, 1934 to 37, 52 to 56, 62 to 65, 84 to 87, and 95 to 98 were about the only 3 times that this happened. And even 95 to 98, I don't really include because there was a correction in 97. But those other 5 times where it happened either ended in a vicious bear market or actually a crash. So I just think that maybe they can hold this up long, but once it cracks, it's going to be like going down, you're going up a stairway, you're going to go down an elevator,
Yeah.
So it's I think that once it cracks, and so much of the trading now is algos and robots and hedge funds trading off these algos and robots, is that they're all going to go from buy to sell, and then if credit markets tighten up, the biggest buyers of stock right now are buybacks by companies buying back their own stock. Like I think there's something like estimated to be 450 billion of inflows into domestic securities this year, and 460 billion of that is stock buybacks. So there's actually a net $10 billion outflow outside of that, right?
That's crazy.
So once those buybacks dry up, then there's nothing to soak up the selling as well. And then I think it's just going to be, even people think don't fight the Fed, they're going to be surprised how fast this market goes down when it goes down, because 2007 and 2000 also had two interesting phenomenons in that, one of my mentors also was Martin Zweig. This is another reason I'm not as adverse to bear markets, because Zweig made a fortune in the 87 crash. Well, not a fortune, but his fund made 9% the day of the crash because he put 1% of his fund's assets into put options about a month before the crash. So, because he has this certain indicators that told him that the market could crash. And but what's interesting about that, and he was the one who invented the term "don't fight the Fed." So what's interesting about that is we go back to the last bear market in January 2001, or last two bear markets. January 2001, the Fed began cutting rates. In August 2007, and so virtually the entire way down, the Fed was cutting rates. And it didn't work until it did.
Right. Took a long time. A lot of rate cuts.
I laugh when these guys tell me don't fight the Fed because the market's gone straight up. Because I'm like, you know what? When this finally cracks, first of all they can do now is print more money. They can't cut rates anymore. Their only tool left is again to print more money. And they've even shown the studies that the last couple quantitative easings have had less of effect each one. So once the next quantitative easing happens, it's not going to have the effect they want, and I really think that the market will be able to deteriorate. Because I think right now it's just a confidence game. It's the market's gone up, companies have. I don't think it's more the quantitative easing, but the way that people have used this cheap money. These companies are now using it to buy back stock, to support the stock market. So once that kind of Ponzi scheme, and it's a total Ponzi scheme by the way, once that ends, then you're just going to see the market almost like crash, like all Ponzi schemes crash. So I think it's more the confidence factor that when they start printing money, at some point rates will actually go up because they'll lose control. And then, of course, companies can't do these stock buybacks and whatnot, and then the market can really, really fall. And again, just look at the charts. Just forget if you knew that they were even doing all this, financial manipulation and sort of thing, right? Just go look at the charts of these stocks. And I'm not talking about the high-growth tech stocks. We've talked about this many times. We're talking about the Disneys and the Altrias and the Krugers and these Johnson & Johnson, these kind of stocks, and they're going like straight up and trading like tech stocks. 3M is another one, right? And the reason being for that is quite simply because they have access to this cheap money to buy back stock. And people are desperate for any kind of yield mixed with growth. So if you're like some company like Nike, and Nike only pays about a 1% dividend, trades at 30 times earnings, but they've had some good numbers recently. So people are like, well, I'd rather own Nike, get 1%, plus get growth, than own a 10-year treasury at 2%. And that's kind of the whole mentality behind this. And I think it's just going to end really, 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 really badly. And I guess in a way I become very jaded towards all this because I think it's just, I don't want to always, but I think it's almost like a scam now. I just think that you got these companies and you got Wall Street and you got the Fed just trying to make the market go as high as it can. And I think there's a certain amount of desperation to it too, because I think everyone knows, and I think so. I think you're agreeing with me. This is kind of the last bubble, like last bull market for a long time in traditional equities, and they kind of know it, so they're just trying to milk it for all they can.
Well, it's kind of funny because last year I was at some country club at home, and this guy was a stockbroker there. And he told me that he thought all this would end one day and it'd be a disaster and this and that. And this guy's in his 70s, I think. But then he said...
But when is it going to end?
Well, then he said, well, it's something my grandchildren will have to worry about. So he thought...
It's going to end in like 20 years.
Yeah, that it won't end in his lifetime, so he's not worried about it. And the thing is, this is kind of a little sounds maybe a little funny, but if you read, I used to read, not that I believe in this stuff, but there used to be these conspiracy books that were real popular in the 90s about the New World Order and all this kind of crap. And one of the figures they would talk about is Nelson Rockefeller. And what Nelson Rockefeller did is he created something called the Trilateral Commission, and he's this Council of Foreign Relations and all this kind of stuff. And he made these statements, like in the 70s, that he wanted a global economy and a new world order, and all these countries cooperating, and the conspiracy people make out like this is very sinister stuff.
Yeah, I've never actually believed that. Like it was sinister.
But anyway, whether it's sinister or isn't sinister, one of the things that's actually kind of funny about this is, here's a guy that people say is a member of this power elite running the country, and he's got this plan of what he wants to do, and it's sinister and this and that. And what's I think is really interesting is there were people like that back then that did have this vision of what they wanted to do. And today, I don't think there's anything like that in the United States, that the people in power or whoever, I don't really think they have a plan at all. It's just like chaos. So the thing about the stock market and these buybacks, I think that people, we are saying that when it ends, it's going to be a disaster and this and that. And as you go like to 2007, there was some quotes by, I think he was the Bear Stearns guy, where someone said, the real estate bubble is
the Citigroup.
Yeah, the Citigroup guy. You got to dance. You got to keep dancing. So
till the music stops.
Till the music stops.
And the music, by the way, when he said that, the music had already stopped. It already had stopped.
Yeah, that's a good point. Yeah. So if you look, that's one of the things that really was fascinating to me about the 2008 thing was how they all went bankrupt. All Wall Street, these banks, these are supposed to be really smart people, and they couldn't stop themselves because they had to dance. Is the way this guy put it. So today, I don't really think they think that they're running a scam or something. That they just think that this is the way it's going to be for a very long time. So, for example, Bill Gross last year made a fund that was like going to bet on low volatility forever. And I just think they hope and therefore convince themselves that they can just keep doing this. But any amount of volatility in the bond market or the stock market will change the entire game. I mean, just a 15% drop in the stock market would drastically alter everything. Well, and a 15% drop is a normal thing. And that's how unstable the situation is. So it is a scam. It is a scam, but I think these people think they're not scammers, and they have no vision for the future except to just continue and hope they can just keep doing what they're doing, and they're going to drive the whole country to hell. Well, and we'll be praying for a Nelson Rockefeller lunatic or something.
Well, okay, here's the thing. You're thinking about how they have no plan. You look at the Federal Reserve. That's the perfect example. And again, I'm not really think they're sinister and all this and that. I just think that they're just more incompetent rather than anything else. And you go look at them right now, is that they talk about the wage gains and interest rates and this and that, but this is all predicated right now on the stock market boom.
Well, that's a fraud, is the economic.
Yeah, that's all, whatever, man. That's all Orwellian. That's all. Yeah. I tell people when I see that employment report every month, I go, the chocolate ration has been increased, right? I don't believe any of those numbers. So the thing is, I actually, just to detour before I get back to the Fed, if everything's so great, why did the Republicans sweep in the elections? Because that was people's way of saying, no, things aren't good, right? Regardless if I don't care less about the two parties, but it's just that's really what that was. That was a vote that things aren't good. So for them to say that unemployment is low and wages are, that's nonsense, right? That's just everyone knows that the economy has totally changed. It's nowhere near good now as it was, pre the financial crisis. So to get back to the Fed, this is where they make no sense because they talk about these numbers and this and that. The whole thing is predicated and the stock market's gone up. There's a trickle-down effect into the economy. And then, then people will spend those stock market gains and help the economy. And once the market drops 20 or 25%, that ends.
Yeah.
Then all of a sudden people don't have those gains to spend. And they're
scared.
And they're scared. And then they're going to go print money again. So they just can keep talking, basically until the market, they can try to keep the market propped up as long as they want, but as soon as it changes, all the rhetoric changes too. They go from this nonsense that they might raise rates to printing more money. So it's like that's where we're saying there's no real plan. They're just trying to prop all asset prices up to help the economy, and then they'll just go into panic mode when that reverses. This is no Paul Volcker raising rates to kill off inflation with an actual kind of a little plan there. This is just like nonsense. This is just like winging it, you know?
Yeah.
So, and then these guys at the Fed, like this Fisher guy, then go work for Pepsi for a time.
Well, that's the revolving door.
Yeah, so, well, that's part of the problem, too.
Yeah.
Eddie, I guess we should, Well, actually, and the last thing we want to talk about here, because we're talking about more big picture stuff, is we both think that even though, we're talking about the stock market, it's overvalued, the stocks can go down. What do you think, about the bond cycle? Because I think where the real bubble is right now is fixed income. We've talked about these companies, because the companies are able to buy back stock because they're able to borrow so cheap. So what is your view on the long-term view for, the government bonds or the bond market in general? And I think this is kind of an interesting point. I think, again, where me and you are real contrarian at the moment, and most people maybe wouldn't agree with us with what we're going to say, but, what's your view on that,
Well, I think that's the real, that's something, we've had two bear markets in the U.S. stock market where the bond market went up while stocks declined. And historically, the smart way for someone to invest is have a proportion of their money in stocks and a proportion in bonds, because that's typically what happens in a bear market. However, I think we're headed for a bear market where both will go down. We're both
like the 70s.
Yeah, like the 70s, where both will have bear markets at the very same time, because we seem to be at a manic top in bonds, maybe even more so than the U.S. stock market, because of where interest rates are, and people are even buying negative bond yields, meaning they're going to lose money if they hold the position, and they're just hoping it goes up.
Yeah, they're hoping it goes more negative, so the price
really
goes
crazy.
up. Yeah.
So, but to me, that's equivalent of buying the Value America internet stock, But these aren't individuals doing it; these are institutional investors. So, but I just think that's a sign that we're going to go into a bear market in bonds. I don't know if they're going to start at the same time as the stock market, or they could, maybe not. I don't know exactly the timing of it. I'd always assume that it would happen later, that the stock market would go into a bear market, then bonds maybe a year later. But, it's hard to say, because the past few weeks they've actually been falling at the same time. And so that's actually very troubling. But to me, for the economy and stuff, I don't really think the stock market going into bear market will by itself have a huge negative impact on the U.S. economy, because most people, the average person, doesn't really have much in the stock market because the economy sucks so much, and younger people don't have hardly anything. So it's really just a small number of people invested now in the U.S. stock market, but they're financially dependent upon it, so they will get hurt. But I think the actual bond market has got more ramifications, because if interest rates shoot up, at some point in the future, that will hurt the economy for a period of time, and it really will make huge changes, and we will have to see how it all plays out.
Just to finish and segue from this is, I think the first place it's going to happen in the Western world is in Japan. I think that people don't think the Japanese bonds can go up because they've been low for so long, but Japan, if you look at them, this is the whole Kyle Bass argument, that they have a xenophobic populations, they have no immigration, they have declining populations, so they can't support this welfare state, right? Their debt to GDP is over 220%, I think it's like 230% to GDP. The only thing that's reason the government's solvent is because the 10-year bond is 0.4% and the 5-year bond's 0.1%. So what I think is that, and even though the central bank there is buying all the bonds, remember the bond market still trades day to day. So if something like 1 or 2% of the bond market, and this goes for all bond markets, but this is more so concentrated in Japan, revolts, their rates can go to 1 or 2%, and at 2%, Japan is almost insolvent on the 10-year bond. So they have much less wiggle room than, say, the United States does, right? The United States could probably have rates go to 3, 4%, still be okay. Really, at 5 or 6% is where we can run into trouble now, right? So I think that will happen is the first place where this, because my feeling, too, is that their quantitative easing is way over the top. They're, at our peak, we were printing $1 trillion a year. They're printing the equivalent of the U.S. printing $3 trillion a year. So, they're as compared to their GDP, they're printing 3 times as much money. So, I just think they've gone way over the top, and at some point this will all kind of, again, if you believe in Austrian economics, that you'll say that the market's going to revolt against this manipulation, and that would be the first place you'll see a bond market crisis. Now, initially, you may not see that. You may see people go into German or go into American bonds, out of a flight to safety trade. But I think that, when it happens in Japan first, will then kind of start the whole sovereign debt crisis around the world. Because let's say the U.S. responded to a Japanese debt crisis by, we're going to print money and buy our bonds back because there's a credit, we want, But no, what I'm saying is, aren't investors going to look at that and say, well, the reason Japan is in their problem is they printed too much money. So now you're going to print more money? Right? So I think that is kind of like, I think when one of these big Western governments, and I'm not talking about Greece, I'm talking about a Japan, an Italy, United States, those are three of the biggest 5 bond markets in the world, by the way, the 3 I just mentioned. Japan is second, the U.S. is first. When one of those bond markets revolts, I think is when you can actually see a big bear market in bonds. And because the U.S. is the reserve currency of the world, it probably will be the last one to go. But I think it will go. And I think that's an interesting point just to end off here. We saw subprime. We talked about the financial crisis. But remember, Japan is the second biggest bond market in the world. So if their bond market kind of blows up, that is going to have serious ramifications for the financial system all over the world.
Well, I want to ask something about that. Last, we're saying this about bonds.
Yeah.
And last year, and I was saying before that I just think that people just think the way things are will just keep going on for years. I mean, that's the projections of Wall Street people and the Bill Gross thing and, this new normal and all this kind of business. And so they kind of just assume that the economy's bad, it's going to stay bad, and rates are going to stay low, and this is just the way it's going to be. And we're talking about a bond bear market, which throws that whole scenario that they claim totally out of whack. Well, let me ask you this about it. Last year,